How to claim whiplash through insurance. The Royal Swedish Academy of Sciences has decided to award the Bank of Sweden Prize in Economic Sciences in memory of Alfred Nobel 1997 to Professor Robert C. Merton, Harvard University, and to Professor Myron S. Scholes, Stanford University jointly. The prize was awarded for a new method to determine the value of derivatives. We could be talking about a physical assets or a non-tangible asset such as a contract between two parties. An asset is also an investment, an insurance policy, a bank guarantee, and any other form of contingent liability, corporate or not. Scholes himself said that his formula is good for any situation involving a contract whose value depends on the future value of an asset. The discipline of risk management is relatively old. As early as 200 years ago, households and firms were able to defray their risk and to maintain a level of risk acceptable to them by redistributing risks towards other agents who were willing and able to assume them. In the financial markets, this is done by using derivative securities, options, futures, and others. Futures and forwards hedge against future risks. These are contracts which promise a future delivery of a certain item at a certain price no later than a given date. Firms can thus sell their future production in advance at the futures market specific to their goods. The risk of future price movements is reallocated this way from the producer or manufacturer to the buyer of the contract. Options are designed to hedge against one-sided risks. They represent the right but not the obligation to buy or sell something at a predetermined price in the future. An importer that has to make a large payment in a foreign currency can suffer large losses due to a future depreciation of his domestic currency. He can avoid these losses by buying call options for the foreign currency on the market for foreign currency options. Black, Merton, and Scholes can be applied to a number of economic contracts and decisions which can be construed as options. Any investment may provide opportunities to expand into new markets in the future. Their methodology can be used to value things as diverse as investments, insurance policies, and guarantees. One of the earliest efforts to determine the value of stock options was made by Louis Bachelier in his PhD thesis at the Sorbonne in 1900. His formula was based on unrealistic assumptions such as a zero interest rate and negative share prices. Prior to 1973, people discounted the expected value of a stock option at expiration. They used arbitrary risk premiums in the discounting process. The risk premium represented the volatility of the underlying stock. In other words, it represented the chances to find the price of the stock within a given range of prices on expiration. It did not represent the investor's risk aversion, something which is impossible to observe in reality. The revolution brought about by Merton, Black, and Scholes was recognizing that it is not necessary to use any risk premium when valuing an option because it is already included in the price of the stock. In 1973, Fisher, Black, and Myron S. Scholes published the famous option pricing Black and Scholes formula. Merton extended it in 1973. An investor that holds the share and wants to protect himself against the changes in its price can eliminate the risk by selling options as the number of shares he owns. If the share price increases, the investor will make a profit on the shares which will be identical to the losses on the options. The seller of an option incurs losses when the share price goes up because he has to pay money to the people who bought it or give to them the shares at a price that is lower than the market price, the strike price of the option. The reverse is true for decreases in the share price. Yet the money received by the investor from the buyers of the options that he sold is invested. Altogether, the investor should receive a yield equivalent to the yield on risk-free investments. Changes in the share price and drawing nearer to the maturity date of the option changes the delta of the option. The investor has to change the portfolio of his investments to account for this changing delta. According to their formula, the value of a call option is given by the difference between the expected share price and the expected cost if the option is exercised. The value of the option is higher the current share price, the higher the volatility of the share price, the higher the risk-free interest rate, the longer the time to maturity, the lower the strike price, and the higher the probability that the option will be exercised. All the parameters in the equation are observable except the volatility, which has to be estimated from market data. If the price of the call option is known, the formula can be used to solve for the market's estimate of the share volatility. Merton contributed to this revolutionary thinking by saying that to evaluate stock options, the market does not need to be in equilibrium. It is sufficient that no arbitrage opportunities will arise. So Merton was not afraid to include a fluctuating interest rate in his treatment of the Black and Scholes formula. His much more flexible approach also fitted more complex types of options. But their contribution had both theoretical and practical importance. It assisted in solving many economic problems to price derivatives and to valuation in other areas. Their method has been used to determine the value of currency options, interest rate options, options on futures, and so on. Today we no longer use the original formula. The interest rate in modern theories is stochastic. The volatility of the share price varies stochastically over time. Prices develop and jumps. Transaction costs are taken into account and prices can be controlled. A share can be thought of as an option on the firm. If the value of the firm is lower than the value of its maturing debt, the shareholders have the right but not the obligation to repay the loans. We can therefore use the Black-Scholes to value shares even when are not traded. Shares are liabilities of the firm and all other liabilities can be treated the same way. Insurance policies and financial guarantees can be evaluated using option pricing theory. Insurance against the non-payment of a debt security is equivalent to a put option on the debt security with a strike price that is equal to the nominal value of the security. A real put option would provide its holder with the right to sell the debt security if its value declines below the strike price. Option contracts began to be traded on the Chicago Board Options Exchange in April 1973, 1 month before the formula was published. It was only in 1975 that traders had begun applying it using programmed calculators. Thousands of traders and investors use the formula daily in markets throughout the world. In many countries it is mandatory by law to use the formula to price stock warrants and options. In Israel the formula must be included and explained in every public offering prospectus. Investment portfolio managers use put options to hedge against a decline in share prices. Companies use derivative instruments to fight currency interest rates and other financial risks. Banks and other financial institutions use it to price new products, offer customized financial solutions and instruments to their clients, and to minimize their own risks. Merton analyzed individual consumption and investment decisions in continuous time. He generalized an important asset pricing model called the CAPM and gave it a dynamic form. He applied option pricing formulas in different fields. Scholes studied the effect of dividends on share prices and estimated the risks associated with the share which are not specific to it. He is a great guru of the efficient marketplace.